Hi guys, welcome back to this Moneycontrol live stream. You're watching Closing Bell with me, Nandita Khemka. What a fabulous Friday it turned out to be for the markets, and all thanks to the IT pack, a 4% up move coming in on that index. Courtesy TCS reported good set of numbers. Beat expectations in terms of constant currency revenue growth as well as dollar revenues, and of course clearly cheered by the street because that was one pocket that sent the Nifty to record levels today. So far this week we've been witnessing profit booking, a couple of days of profit booking, although those dips were also getting bought into. But today's decisive move on the upside, we'll have to see whether or not that could push the Nifty to that 25,000 mark ahead of budget or not. In terms of movement, the Nifty gained, in fact, in excess of 0.5%. 24,500, that's holding out. On the Sensex as well, 80,500, but the broader end of the markets were underperforming the benchmarks today. So the Nifty mid-cap index, ended marginally in the green, and the breadth was, of course, in favor of the losers today. Almost 2:3, that was the advanced decline ratio on the NSE. Aside of IT, what did well was the energy pack. Even the FMCG lot did well today. What didn't do well was the realty pocket, which saw, profit booking yesterday as well. PSU banks and autos were also among laggards today. In terms of individual movers, then very quickly, top 6 names on the Nifty is of course from the IT pack, TCS, Wipro, Infosys, HCL Tech, which reports numbers after market hours, also gaining somewhere around 3%, but TCS gained almost 7% today. Mind you, top contributor on the Nifty. Among the losers, you have Maruti, Divi's Lab, Coal India, Asian Paints. These are some of the names. Even private banking names were on the losers list, given the fact that the Nifty Bank Index was underperforming today as well. Mid-cap IT and realty, I beg your pardon, mid-cap IT and railways, some of the other sectors that were doing well on the Nifty 500 gainers list. You will find a lot of these names today. But of course, it was a 6th straight week of gains, and I have a big market voice joining me on the show, Ajay Bagga, market expert, to share his thoughts on where we are headed from here. Mr. Bagga, always a pleasure chatting with you. Hope you're doing well. I'm interacting with you after a very long time. But, before I move on to the, trend or what trends to follow at the current juncture, I want to ask you about the IT pack. Of course, we went into the earnings season with minimal expectations from the IT lot, but what TCS has delivered, has clearly brought about a lot of cheer in the market. But since management has also pointed out that on ground there has been no change in the discretionary demand environment, would you say it's a bit too premature to see these kind of euphoric moves coming in on IT shares?
Yeah, Nandita, we have to see it in the context that IT has been an underperformer for a very long time, though of course now money is rotating into IT. We saw even in June the mutual fund numbers, if you look at those, they have got back into IT in some ways. So overall Accenture set the stage, and yesterday's IT major TCS gave more strength to this. The key things we have to look at. One, the management was very clear that FY 2025 is going to be better than 24. So probably the worst is over. We have made a bottom as far as the revenue growth and the profit growth goes. These are not great numbers, and the valuations are not cheap at all. However, what is working for Indian IT is the artificial intelligence revolution, and they are at the center of it. Right now, the client contracts are still not coming through, but if you see the earnings announcement and the management guidance, there's a lot of vendor consolidation that is being expected. That will help the larger IT players as well as the mid-cap IT players, which are more technical in nature, say the one servicing auto or servicing industry verticals. So those are the two big things we have to look at. These are cash spewing companies, very well run with good managements, throw out a lot of cash and reward minority shareholders. So a lot going for them traditionally. What was going wrong was the growth, and there was a question mark. I think now we have gone through the worst, and where you will see Indian IT now scoring is that on one side you have the semiconductor companies, the hardware companies, which are enabling AI, and then on the other side of the value chain are the industry participants, the companies which are using these AI solutions. And our Indian IT is an enabler sitting in the middle. You have to have end use cases. If you recall, Infosys top management in its recent meet mentioned that now they have 225 end use cases out to their clients, and nearly 250,000 of their employees have been now trained on generative AI. NASSCOM has put out a report saying that about 1 million Indian engineers are needed by Indian IT for generative AI capabilities. So that is going to catch up. Right now, if you see the usage of AI in most industries is less than 2 to 3%. As that number goes up, Indian IT is going to benefit. So it's a good time to get in, and that's what the market did. Mutual funds were ahead of the curve. In June itself, they started loading up. I'm sure even in sectoral infotech IT funds, there will be flows now coming in.
All right, point taken. A lot of underweights are also being reversed because this was one pocket that has underperformed, other sectors. But talking about the texture of the market, we saw a knee-jerk reaction on the 4th of June, the election verdict day, but we've come quite far from there, right? In a matter of a month, we are looking at 25,000 on the index, on Nifty pretty soon, hopefully, and 80,000 on the Sensex. But here on, what should one really do? Because, valuations, if you look at across the board, sectors are turning extremely expensive, right? And even IT for that matter, as you pointed out, valuations aren't really inexpensive. So where does one really look for valuation comfort now?
Yeah, that is a big truism, and it's true across the globe, not only for us. You can't find real value even in the US, for example. It becomes a difficult market, and all-time highs, what is the characteristic of the market? Companies that deliver as per expectations won't see a pop-up, but companies who are mildly below expectation, leave aside a major miss, even mildly below expectation will see huge sell-offs. So that is the volatility that comes in into markets at all-time highs. The good thing is the corporate earnings are growing. So we are expecting ex oil and energy pack, if you see, nearly an 8% growth in Nifty 50 on the revenue side. Profits will be soft, but again, you have to see where are the profits growing. I think you will see very good numbers from automobiles. You'll see good numbers from industrials, defense, railways. These are growing, but defense railways, I'm cautioning for nearly a couple of months now. All the stories have got baked in, and execution risk is very high because there is double, triple counting of all the good news, and every single SU-30 that you're going to make and export has been accounted for. So there is no place to stumble then. You will have to keep growing. There is a very huge runway. That way, with 10, 12 lakh crores of capex coming in every year with the government, and that's a very well-funded one. You can say, just a small example on a tangent I'll give you, that if you look at the RBI sharing of profits, RBI sitting on $650 billion of FX reserves was earning zero or negative on that. All of a sudden, you're earning 5 to 3%. Over the next 2 years, that 5% will go down only to 3%. And that's another $18-20 billion in RBI's kitty, a large portion of which it passes back to the government. So this RBI transfer is not a one-off, it's a multi-year transfer that you will keep getting. So that fiscal space is there. The government has realized it, that spending on infra means that the multiplier kicks in. So the 10 lakh crores you spent 3-4 years back is coming back as 60 lakh crores increase in the GDP. Take a 12% even tax to GDP ratio. You're talking of 6-8 lakh crores of fresh tax revenues. And that's the buoyancy in tax that we are seeing, 13 to 18% growth in taxes year on year. It's because of this quality of spending. And this is, Nandita, despite private consumption growing only at 4%, agriculture being a laggard, 60% of the population is producing 18% of the gross value added. That's a huge drag. Despite that, for this economy to grow at 8.2 or a nominal 11%, you can make out then that what are the drivers, and you have to pick those drivers in the listed space, and you're more or less okay. So valuations quite high. Are they worrisome? Yes, because there is no space for any surprise. So your margin of safety has got considerably reduced. The third thing is there's so much liquidity coming in that anything that you sell gets picked up and bid up again. So you're kicking yourself after selling a defense or a railways, even if a month back you sold it that at 50, 80 times price earning. What money will you make? But there is somebody coming in and picking it and bidding it up again. So a very difficult time, but the experienced fund managers are generating some cash and sitting on the sidelines. For the retail, best is just keep investing every month. Don't try to go all in, or don't try to time it, because this market will also keep running away. And there are still quite a few things still left to happen in this year. US election, US rate cut will come. RBI will cut by October, December, despite what the RBI governor is talking down. 2 out of the 6 MPC members already last time around were stressing that please cut now. You are going to bring down the economic growth by keeping such high rates. But the majority still felt that inflation is the bigger culprit. In a economy like India, where food is such a big part of the basket and food is not controlled by interest rates, it's very difficult for the monetary mechanism to control who will grow which vegetable and where rain will fall and where drought will happen. It's a very difficult task to maintain that inflation through the monetary mechanism. So I'm expecting a rate cut by December. So short answer, today I'm rambling a bit, but
no, always
short
welcome.
answer, yeah, because there's so much. Valuations not cheap, but growth is there. No place to stumble. Keep 20% cash if you're managing funds. I think raise your cash level. You'll get some chances, hopefully after the budget. So much has got built into the budget that it's bound to disappoint somebody or the other, and you'll get chances. And very highly valued sectors with all the stories baked in, I think book some profits, at least take half the money off there. And where to allocate, I think there are enough, say power utilities, PSU banks have again been hit quite badly, down 4-5%. I think those are good stories, multiple stories. Those can be looked at.
What about private banks? Ever since we've
NIMs get compressed, we'll get the big US banks commentary this evening, on Friday evening, and that will also show the same. Nearer to the interest rate cycle part, the banks' NIMs start compressing. What's working in India? One, very clean balance sheet. Second, huge growth that you are getting. And because of that, the banks will be able to utilize their capital much better. Deposits remain an issue, and you're competing against alternative financial assets and the traditional love for physical assets, especially gold and silver doing so well. We are seeing money going there as well as to real estate and to the stock market as well. So banks have their job cut out. They will have to pay more for deposits. While the credit growth is good, but there is pressure there, definitely. So ALCO pressure in terms of their asset liability management. Second, NIMs will compress, and as interest rate cuts come in, the bank margins normally go down. So they will have to see cost outs. They will have to see which are the segments that they address more. And meantime, RBI is more worried on the risk, so it's raising the risk weightages. So it's becoming difficult to service certain segments like, say, developers, real estate developers, because of the amount of risk weightage that RBI has attached to it, or project financing per se. I think those sectors are getting very difficult to fund for the banks, and there is no easy way out. However, still, it's very good NIMs and historically low bad debts, lessons well learnt, and it's a growth sector. It's sitting in the center of a very massively growing economy, which is underbanked, underserved. So they have multiple year of runways.
Right, a couple of more questions. First of all, what do you think of the consumption pack? Because this was one pillar. On a day when Nifty was down 6,000 points, we saw HUL gaining 6%, and that is something that you don't get to see on an everyday basis. Going forward, do you think FMCG would revive? And if there are any steps to boost consumption in the budget, is this one pocket that one should take position in right now ahead of the budget?
No. I think it's going to be difficult, and at the valuations which these plays are, see, they're good defensive plays. So whenever there is trouble, people sell the more highly valued segments and get into them. But at the kind of valuations we give the FMCG majors, it doesn't make sense with 4% personal consumption growth. You look at their volume growth, their margins growth, it is a big trouble. And with the food prices going up, all the food majors will also see some margin compression. The good thing for them is the rural demand coming. But I would play the rural demand on, say, two-wheelers or tractor majors. Those will do better, and maybe even with durables. So more discretionary than the staples. Staples, the issue is the demand. So we have a problem there. And if it was valued like it's valued abroad, then still you could look at it. But at the valuations that they command, it's very difficult to justify fresh investments into them. So I would say the government will do something for the bottom 20-30% of the population. There will be more redistribution that will help basic consumption to revive to some extent. But for the major consumption and the premiumization to work for these FMCG majors, that needs the economy to grow even faster than this. And see, you and I will not eat more. We will go to a better restaurant. We'll spend on higher quality. But so that 1% and the 20% consuming class are up to their necks in the consumption. You're not getting much more. You'll get premiumization there. So, and for the rest, the government has to do a lot more percolation of money into their pockets. If 80 crores are being given, 5 kg rice and wheat to survive, you can imagine what more is needed. And FMCG will be, third, fourth order preference. So I'm not seeing that sharp a recovery, and not at these valuations. If they had fallen more, they would have become attractive. They haven't.
What are the top 3 preferences you would have in terms of sectors now, Mr. Bagga?
Banks, utilities. So power segment, I think you'll get 5-10 years of growth there. Automobiles, again, the volumes have started to come off because of the base effect, but it's a basic need. Consumer durables, I think these are a few of the sectors. And IT as a contrarian bet. We started buying IT about 2 months back, and increasing the exposure now, overweight on IT, and I think I'll keep buying more IT. You will see this coming through, as they start demonstrating, because companies worldwide are looking at cost outs, are looking at optimization, productivity triggers, and that's going to come through IT. And our IT that way is very innovative, and you will get a lot more traction for them. Very well-run companies. I think we have seen the bottom. Very confident on IT.
All right, confident on IT. And very last question and very quickly, a September rate cut from the Federal Reserve, is it a given? Given the kind of data that's come in, inflation data, even jobs market is cooling off now, and the Fed chairperson himself has said that keeping rates for longer could be actually detrimental for the economy. Would you expect a September rate cut?
Yeah, the big change which he did on Wednesday in the Senate briefing, he moved from I'm looking at a level to I'm looking at a trend. And if you analyze the last 3 months of CPI, you come to 2.1. So we are very near to 2. I think the PCE number for June will come quite low in the 2.1, 2.2 kind of numbers. So we are very near to it. Now, do they do it? I think when the market is doing so well, there's so much liquidity and the economy is doing so well, there's no need to do it. It's a soft landing that the US is coming to. There are some pockets of worry, but still with 200,000 jobs a month, with hardly half the companies reporting, you're not in trouble. It's still not a slowdown. So I think he could hold his hand, but today the market is saying 90% plus chance of September and 80% plus for 2 by December. I'll bow down to the market, but the market was spectacularly wrong, Nandita. Last September, 6 rate cuts for this year, January 6 rate cuts. May was a done thing. In even February, May was looking at 100% of a rate cut, didn't happen. So we'll cross it when we get there. And rate cuts are not good news normally. Of the last 22 cycles in the last 100 years, 13 times market has gone down. Every time it goes down immediately, as happened yesterday. That's more, sell the fact, buy the rumor, sell the fact happened in the market. And there will be a rotation into the broader index. That is happening, mid caps, small caps, away from the growth and momentum. All that will happen. But 1 year later, normally the market is down 22 out of 22 times. But that is because mostly you do it when recession is happening. Here the economy is still growing. The consumer is still okay. And there is growth in the US economy. There is huge liquidity still out there. So rate cut actually not justified in a classical economist sense, but needed, very much needed for political reasons. For market sentiment reasons. So probably it will happen by September.
All right, of course, we'll watch out for that. And of course, I will be touching base with you when that happens as well. But of course, around budget as well, I think I will be touching base with you. And I will be looking forward to a longer conversation with you then as well. But with that, Mr. Bagga, always a pleasure chatting with you and getting all your insights into the markets and various sectors. Look forward to our next conversation. Have a great weekend.
Sorry for being long-winded today because just too much news flow. I was trying to bring that in. So very sorry for the long answers today.
No worries. Thanks a lot. Always good to have your insights.
Thank you.
Well, with that, of course, we've come to the end of this edition of Closing Bell. It's a good close to the week. We have ended at record levels, 24,500 right there on your screens. Let's see whether or not we can extend it to 25,000 next week itself or not. But with that, I'm timed out, of course, out of the studios and starting my weekend. Hope you guys do that as well. Come back and join us on Monday morning with the markets. But for now, it's a goodbye.